I want to talk about margin trading, which is borrowing money to buy stock or borrowing stock to sell and sell short if you want to bet against the stock. But to do that, we need to have some very basic understanding of accounting principles and balance sheet ideas. So this is a good place to take a little tangent and talk about balance sheet and accounting stuff. And then we can also take a small trip to personal finance and personal balance sheet. This is very useful stuff that everyone should kind of know. Again, if you're in business or finance, this super basic accounting stuff you'll see all over the place. And it can help guide some of your financial decision making. Okay, so what are assets and liabilities? Assets are items that will provide an economic benefit to you in the future, where liabilities are economic obligations. So some examples. Assets can be tangible, real things that you can immediately use or dispose of. Equipment, vehicles, cash. Even if the cash is like in a checking account, it's still considered a tangible asset. You can measure its value very precisely and move it as you see fit. Where intangible assets are things like patents, right, intellectual property, value of a brand. If a company spent a lot of money on marketing to build their brand, that brand value is an intangible asset. And then on a personal level, if you're thinking about yourself as an individual, your education and your skill is an asset. Your physical health is an asset. You're spending a lot of time and paying UB a lot of money to get this education. And the idea is this education is something that is going to be valuable to you. It will provide a future economic benefit. Otherwise, it doesn't make sense to do that, right? Why would people go and get an education, get a degree? Now, examples of liabilities would be just debt, essentially. You owe people money, you owe people, could be like inventory. If I'm a store and someone pays me money and I have to send them inventory, right? I have to fulfill the order, then I might owe them that inventory. Often, one entity's liability is another entity's asset. The most basic example of this is when you deposit money at a bank. So I put in $1,000, for instance. Now the bank owes me $1,000, right? And this $1,000 that the bank owes me is my asset. In the future, I can go get $1,000 from the bank, and it's the bank's liability because the bank has to pay out this $1,000 to me sometime in the future. Equity is just assets minus liabilities. The basic accounting equation is assets equals liabilities plus equity, so we can rearrange. Equity is the difference between an entity's assets and liabilities. It is a measure. Equity is a measure of an entity's economic value. Quick intuitive example. Let's say I have nothing else but these two things. I have $300 in cash, but I owe someone $100. I have $200 or $300 of assets and a $100 liability. So my wealth total is $200. My equity is $200. Now, balance sheets can be constructed differently. So what you're allowed to put on them can differ depending what it is you're trying to do. So for example, under GAAP, generally accepted accounting principles, which is the most basic accounting principles used in the US for companies issuing their 10Ks, annual reports. Companies are not allowed to put intellectual property that they develop in-house as an asset on their balance sheet. Now, the reason this is done is because regulators want to minimize the amount of room that companies have to manipulate stuff, right? These annual reports are done so investors can get a good sense about the financial health and stability of the company and exactly what the company is up to. And if there is a huge amount of leniency in terms of how valuable this intellectual property could be, it gives the management of the company a lot of wiggle room. They could just say, oh yeah, well, we're going to have a cure for cancer soon, so it's worth $1 trillion, right? If management could just mark the value of their intellectual property as they see fit. Now, there is a problem with this, of course, and that is this intangible asset does, in fact, or can add tremendous value to the company. So companies that have very valuable intellectual property are going to have balance sheets that vastly understate the value of the company. So it's a trade-off. Now what I want to look at is constructing a personal balance sheet to conservatively estimate your level of wealth, specifically your level of liquid wealth and financial stability and power, I guess I would say. So we'll look at all asset values on your balance sheet based on their liquidation value. What this is showing you, what this balance sheet is measuring when you look at the equity of this. If you quickly have to liquidate all of your assets, and quickly could be whatever, some reasonable amount of time, a month, a week, not necessarily that second, but quickly, fairly soon. If there is some medical issue that happened to you and you needed to liquidate stuff to pay for your medical issue, how much would you have available to do so? So you liquidate all your assets and then pay off all your liabilities. How much cash would you have left over? That's essentially what this is measuring. If you look at things in terms of this, you can kind of see how different decisions you make affect your equity immediately. For example, when you have a transaction, your level of wealth will usually immediately drop. We'll show you an example of that in a moment. Okay, so this means assets should only be included if they have liquidation value, i.e., it's an asset that you should be able to find someone willing to buy it from you, and it also must be able to be sold relatively quickly. Usually if you sell an asset quickly, especially something that's a liquid where there's a thin market for it or it's hard to find a buyer, you can still sell it, you'll just sell it at a big discount. So if you're doing this how you should, these illiquid assets should be heavily discounted from maybe their true value that you think you should get for them. You're putting the value that you think you could liquidate them for, not the value you think they're truly worth if you had an infinite amount of time to look for a buyer and sell it to them. And this is normal in accounting, by the way, to make conservative estimates of things. So good accounting practices guide us to be conservative in our estimates of asset value and go lower on our asset values, where all liabilities are given the full value, the full face value of the liability. This is one of my favorite examples, how lending people money can actually immediately lower your wealth. If someone owes you $100, that asset's value to on your balance sheet is not worth $100 because you don't know for sure you will get paid all of that 100, or if you'll get paid at all, or when, right? Maybe that person will pay you back, but in 20 years. Well, $100 in 20 years is worth a lot less than $100 now, right? Think about it in terms of our finance structure. What's the present value of $100 in 20 years? Probably like $30 or something maybe, right? So then if that was the case, the fair value of that asset maybe should be marked as $30, not $100. What I like to do is use EV, expected value, remember the stuff we did in the first week a lot, and estimate the probability that someone will pay me back quickly. Another way to think about this is if you sold the debt to someone else. So I'll use myself as the punching bag here. Let's say I borrowed $1,000 from someone. From Larry. I borrowed $1,000 from Larry. And Larry's like, wow, Nathan is such a pain in the ass to collect debts from. I think he's going to pay me, but it's annoying and he might pay me back slow and I don't know for sure. And so Larry goes to his buddy, his big scary buddy, Adam, and says, hey Adam, I don't want to hassle collecting Nathan's debt. Nathan owes me $1,000. I'll sell you this debt. So Larry is taking the debt asset off his balance sheet and giving it to Adam, and Adam puts it on his balance sheet. How much would Adam pay Larry for that debt? Now, let's say Adam's like, well, I think I can intimidate Nathan into paying the debt reasonably easily, but it's a bit of a hassle, and I could get in legal trouble if I threaten to use force. So, tell you what, I'll buy the debt for 50%. And so Larry might sell the $1,000 debt that I have to him to Adam for $500. This kind of shady transferring of debt and debt collection happens a lot in the gambling community. That's usually where you think about this when you hear buying up debt. You watch these old gambling and mafia movies, and that's where you hear this kind of thing. But our finance and accounting framework helps us understand what's going on. So Adam buys the debt for 50% on the dollar. He pays $500 for it instead of $1,000. Larry gets $500 of cash, and Adam can maybe collect all 1,000 of it from me. If this were the case, well, Larry should be able to put the value of the $1,000 debt to $500 because he could liquidate that debt for a $500 value. Now let's flip the tables. If you owe someone $100, conservative practices, you can't reduce the amount you owe them because you might not pay them or something, right? Or they might die and you don't have to pay them at all because they didn't tell their friends and family about the debt, or dark, terrible stuff like that. You just have to keep it at 100. That's a conservative estimate. You owe 100, it's a liability that has a value of $100. Okay. Real life, or I shouldn't say real life, non-stock market or non-capital market transactions tend to be very different than stocks and stock trading, because stock trading has a very small bid-ask spread, relatively speaking. Bid-ask spread in the stock market is usually less than 1% now. You can buy a stock and sell it immediately, and your round-trip transactions cost is 1% or less. In real life, goods often have a tremendous bid-ask spread. Think of my example with squash and Wegmans. If I can buy squash for, I don't know, what did I say? 2 pounds for $1 or something? How much could I sell to Wegmans for? It's going to be way, 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 way less than that. Maybe like 5 times less than that even. Something just ridiculous. A very good example of this is buying and selling cars. So you walk into a car dealership to buy a new car and you buy it. Let's say it costs you $20,000, so fairly cheap car. Then 2 days later, for whatever reason, let's say you need the money again for a medical procedure, an emergency medical procedure. You have to sell your car. You go to the dealership and sell it, even though it is essentially brand new, hardly ever driven at all. Let's say it was never driven even. Like you only drove it back home, and then the next time you drove it is to the dealership, the used car dealership. The most you will be able to get is around $16,000. Which means, you immediately lose $4,000 when you buy the asset because its liquidation value is $16,000. You bought it for $20, it goes on your balance sheet at $16, so you lost $4,000, or 20% of the cost of the car, right? The bid-ask spread on cars is like 20%. It's absurd. This means you want to minimize these kinds of transactions because they really hurt your wealth. Same thing for buying a house. Buying a house hurts your wealth a lot. It is good to buy a house only if you're going to be in there for a very long period of time. And the reason is the interest rate on a mortgage that you get when you buy a house is usually less than the rent you would pay for that same house. But you immediately pay a cost when you buy the house in the first place. So for the lower rate you pay on your mortgage to actually be worthwhile compared to the higher rate you pay for renting a similar place, you have to be in your house for a long time. So rule of thumb in real estate: don't buy a house unless you are 100% sure you will live in that house for at least 5 years. 5 years is usually the cited break-even point between is it more, are you going to be better off if you just keep renting or buy a house and pay a mortgage and pay interest on the mortgage? Okay, back to this example with a car. Just because your liquid value of wealth, your liquidity goes down by $4,000, it doesn't mean buying a car is necessarily a bad decision, because owning a car might enable you to get to work more efficiently. Right? If you can get to work faster, you might be able to stay at work a bit longer and make more money and make more profit. But it does mean that your liquidity and immediate level of financial stability is reduced. So just understand what is happening to your balance sheet and your financial health whenever you make any kind of transaction. That includes big ones like buying houses, or small ones like going into a store and buying chairs or couches or stuff like this. By the way, one comment here. Under normal accounting practices, like when a company buys something like a car that is helping the company operate and contributing to them making profits, the value of that asset goes on their books as the amount they paid for it. So normally if a company buys a car for $20,000, they put it on their balance sheet for $20,000, and then the asset would go down in value over time. But again, what we're doing, what I am telling you should do, is to have a balance sheet measuring your liquidity and your liquid level of wealth. In which case, for liquidation value, you immediately lose $4,000 when you buy the car. Let's get into an example here. Alright, so here is my balance sheet, and I've blocked out hopefully all the personal info about people that I either owe money to or who owe me money. So on the asset side, we have all of my cash or cash-like assets. We have the bills that I have, in my dresser or something like this. We have a checking account, amount in a PayPal account in Venmo. I have over at Fallsview, the casino across the border, about $12,000 in Canadian currency. This is kind of the more interesting section of the balance sheet, which is what I want you to look at. Debts of people I blocked out. So these are people who owe me money. This is the amount of money each person owes me. And this is the fair market value of what the person owes me. So, for example, take a look at, let's look at this one. This person owes me $700, but I'm saying the value of this debt is only $140. One way you can think of it is I'm saying there's only a 20% chance that this person is going to pay me back in a timely fashion. Right? We take the sell and the face value, sell times 20%. This person has a bit better chance of paying me back quickly. I give them a 50% chance. These people I've essentially written off. I'm just keeping these debts on my balance sheet to remember that they owed me money and they didn't pay me. So they're people I will not loan money to again, and their debt is worth essentially nothing. I could just take this off the balance sheet, but again, I keep it there so I remember, oh, I loaned these people money and they didn't pay me back. Then I have trading stuff. This is a retirement account, a small sum of money I have in my Ameritrade account. I trade with a more substantial amount of money on Interactive Brokers. That's the other broker I use. That's where I usually do my serious trading. Now, not all of this money is mine. Essentially, I have friends or family who I said, okay, I'll take some of your money and trade with it, and they essentially own a percentage of this, which you'll see over here. Then there's other little things. There's some silver coins I have, like tradable commodities. Again, it's silver that I could go and sell and liquidate if I wanted to. This is the company I started. I'm president of this company named Brand Name Depot, which is out in Elma, New York, about a 30-minute drive from UB. And this company owes me $16,500. I've lent the company $16,500. And again, there's a chance the company will fail and won't pay me back, even though, I'm president of it and help run it. So I think the probability is low, but I'm being conservative here. We always want to be conservative. So I'm saying there's maybe only a 75% chance the company will pay me back. In reality, it should be higher than that, but we're being conservative. running along with this idea of being conservative, I own 43% of this company, or 86 shares. I'm saying that the company value is $100 per share. In reality, it's probably a lot more than this, like maybe $400 or $500 a share, or possibly even $1,000 a share. I mean, that's a huge differential. But the problem is this is a private company. We are not traded in the public market, obviously. We are very, very, very small. We're a little startup company. So I need to find a buyer. It's hard to find a buyer that actually wants to buy a portion of this company that I started. And so in order for me to give a fair liquidation value, I have to discount the shares a lot, right? If I had maybe 4 years to find someone, I could sell the shares for a lot more than 8,600. But if I had to find someone in the next 2 weeks, maybe $100 a share is reasonable. So again, that's a conservative estimate of the value. I have some Bitcoin SV here. I traded cryptos a fair amount a while back and ended up getting stuck with some of this stuff after one of the forks. Don't need to go into that if you don't know what it means. Just don't worry about it. No Bitcoin anymore. I backed someone's business for about 10 G's. And again, business environment might be rough now in the COVID market environment, although it's been doing fine so far, but I'm skeptical. I told you I'm a bit of a pessimist and skeptic, so I'm guessing that either you can think of this as this person has only a 50% chance of paying me back in a timely fashion, or that when he pays me back, and if it's soon, it'll probably only be 50% of it if his business fails. Then lastly, another low liquidity item. I played this trading card game called Magic the Gathering, which probably a handful of you heard about it. I played it quite seriously back years and years and years ago, like 20 years ago. I was extremely young when I got into it. And some of these cards actually have real value now, shockingly. So this is, once again, a conservative estimate of what I could liquidate the collection for. If I could take time and learn the value of all the cards and sell them one at a time on eBay, I could probably get $3,000 for it or so. That's my estimate. But I don't want to spend all the time doing that. That's a great deal of effort and energy on my half. What I want is someone to come in, take a quick look, and say, I'll rip you off and I'll give you $1,000 for your old cards that you have. And I would be like, fine, take it. Take the cards, give me the 1,000. I know for sure I could at least liquidate this and get $1,000 for it, even if I had to do it very quickly. Okay, so that's all my assets. And the key thing to note here is even things like the debt, right? Or the face value of illiquid things like collectibles. Its true liquidation value has to be marked down tremendously because you pay a big cost to find someone to take the other side of your transaction. Okay, now liabilities. I owe, about 5,600, 5,500 to people in this small passive portfolio I ran. These people own essentially pieces of this larger portfolio, so this person has about 40% of it, right? So of this 190,000 I trade with, this one person I owe about 75 grand to. And then other miscellaneous debts, I owe some poker friends like 750. Someone backed me and to play a game in Canada, right? They said, okay, I'll give you money and you can play and I'll take all of the risk and most of your winnings. Or there's other backing agreements too. We can go into gambling and backing, that's a different game, but don't worry about it right now. Essentially, they gave me $7,600, and now because I won like 5,000 or so, 4 or 5,000. And so of this 12,300 of Canadian dollars that I have in the casino at Fallsview in my account there, I immediately owe 7,600 to my friend who backed me, right? So we have that as an asset and we subtract that as a liability that I owe. The market value, because you're living in the U.S., is in terms of U.S. dollars, which is why on this spreadsheet I have a conversion from Canadian dollar to U.S. I don't know what the conversion is right now, but as of July 9th, it was about 75 U.S. cents per 1 Canadian dollar. Anyway, we add up all of my assets, and it looks like I have about $250,000 of assets, and we add up all of my liabilities, and I have $168,000 of liabilities, and my equity is the assets minus the liabilities. So even though I have a lot of assets on my books, right? I mean, I have a brokerage account that's almost 200,000. My liquid wealth isn't even 100,000. I'm not that well off. That's not enough to buy a house, right? So if someone just owned a house themselves and didn't have any liabilities, their personal wealth would be greater than my personal wealth. This is a project I want you to do. I want you to get your own balance sheet made. If you're uncomfortable showing financial details of your life, by the way, that's totally fine. Just make some stuff up. Some of the stuff I want you to think about, though, I guess whether it's real life or made up, and if you make it up, try to add some interesting things on both sides. Liabilities you will likely have. We're students. We have a lot of debt to universities often, right? If you took out a student loan, that's a very big liability you have. If you owe UB money but haven't yet paid it, right? You owe a payment. That's a liability. Or if you owe money for rent but haven't paid it, that's a liability. Your cash is an asset. If you have a car or a vehicle, that's an asset. All of the financial accounts you have, if you have a trading account, you trade with a bit. These are all assets, right? For most people in this course, since we are not putting things on our balance sheet like education and how valuable that is, we're just putting the liquid assets that you can actually liquidate and have liquidation value. Most people in this course should have negative equity values. And the reason is, again, things like student loans are a huge liability, and you haven't had time to go out and work yet and build your wealth. And that's okay. That's nothing to be ashamed of, and it's no problem at all. It's just, it should tell you where you are financially. If you have a big negative equity value, you better get out of school and get to work and reduce your liabilities and get that equity up. You know, try to get that equity above zero in the first 5 or 10 years you get out of college if you can. Hard to do for some people, but in finance where the jobs are a bit higher paying, it's often possible. So anyway, I will make a little post that talks about more specifically what I want with this balance sheet project. Sorry this was a bit longer than normal. I hope you didn't lose your focus. Maybe I should have split this up into 2 different lectures. But in any case, hope you could follow, and this will help us when we talk about margin trading and how it looks on the balance sheet for our stock trading in the next video. So have a good night, everyone. Take care. Bye-bye.